Federal retirement income is not taxed the way most employees expect. Many federal workers assume taxes automatically drop after retirement. Others believe their pension, TSP, and Social Security are taxed separately. What most employees miss is that federal retirement taxes are layered and interconnected. Your pension affects your tax bracket. Your TSP withdrawals affect how much of Social Security becomes taxable. And the order in which income is taken can shape your long-term financial outcome. Understanding how federal retirement income is taxed is not about avoiding taxes completely. It's about knowing where taxes appear and how to manage them strategically. Let's break down the three main income sources and the hidden tax dynamics many employees overlook. Federal pension. Taxation, the baseline. Most people forget. Your federal pension is generally taxed as ordinary income at the federal level. From a tax perspective, it behaves much like a paycheck. That surprises many retirees because the pension feels different from employment income. But each monthly payment adds to your taxable income every year. A small portion may be tax-free due to after-tax contributions made during service, but most of the pension remains taxable. State taxation varies widely depending on where you live. What most employees miss is that the pension creates a permanent tax baseline. Unlike TSP withdrawals, you cannot pause or reduce pension income to control taxes. It arrives consistently, setting the starting point for your tax bracket before any other income is added. That baseline becomes critical when additional income sources enter the picture. TSP taxation, where planning decisions matter most. The Thrift Savings Plan introduces flexibility and complexity into federal retirement taxation. Traditional TSP withdrawals are taxed as ordinary income. Roth TSP withdrawals, when qualified, are generally tax-free. The key issue isn't just which type you have, it's how and when withdrawals happen. Many retirees focus on account balances instead of taxable income. Large withdrawals can push retirees into higher tax brackets. They can also increase how much of Social Security becomes taxable later. This is why retirement tax planning strategies focus on coordination. TSP is not just a savings account. It is a tool for managing income timing and tax exposure. Balancing traditional and Roth withdrawals can create flexibility, especially during early retirement years before Social Security begins. Social Security taxation, the most misunderstood layer. A common belief is that Social Security is tax-free. In reality, Social Security can become partially taxable depending on combined income. Combined income includes adjusted gross income, certain interest income, and half of Social Security benefits. When income crosses certain thresholds, up to 85% of Social Security benefits may become taxable. That does not mean 85% is taxed. It means that portion is included in your taxable income calculation. What most employees miss is that Social Security taxation is driven by other income sources. Pension income and TSP withdrawals directly influence whether Social Security becomes taxable. This is why retirement planning cannot treat each income source separately. The real issue, income stacking. The biggest tax surprise in federal retirement comes from income stacking. Individually, each income source may seem manageable. Together, they can push total income higher than expected. A pension provides stability. TSP withdrawals provide flexibility. Social Security adds another income layer. But when all three are layered without planning, taxable income rises quickly. Two retirees with identical income sources can have very different take-home income depending on withdrawal timing, Roth versus traditional balances, and tax strategy. This is especially important for high-income federal employees who want to reduce taxes over time. Final takeaway. Federal retirement income is taxed across three main sources: your pension, your TSP, and Social Security. Each follows different rules, but they interact inside the same tax system. The biggest mistake is treating them as separate decisions. Successful retirement planning focuses on coordination, not just accumulation. The goal isn't simply to maximize income. It's to create predictable, sustainable income after taxes. Because in federal retirement, success isn't defined by how much you earn. It's defined by how much you keep.